So when can I take out a policy loan? Well, it's a pretty simple question. You can take out a policy loan whenever you want at any time. So just a few pieces of logic around how these loans are structured. So remember, we're funneling money into that cash value, which is the equity into our policy. And the insurance company allows us to loan out against that balance in our policy up to about 95 to 98%. Depends on the carrier. They all have different restrictions. So if you deposit money and it clears, let's say 2 or 3 days from now, you can draw on that money or loan on that money whenever you want at any time. And the beauty of that is it gives you full control over that piece. So that loan, obviously, there's going to be an interest rate that comes out with that. The insurance company is going to charge you a simple interest rate. And you can look at some other videos we have that describe the difference between simple and compounding interest and why it's advantageous for you as the lendee to be paying back simple interest when your original principal is gaining or being paid compounding interest. So you're growing compoundly and you're only paying out simple interest. So it's much more effective. But look for other videos on that so you can get clarity if you need it. The other thing is when people hear loans, they think, okay, well, why am I taking out a loan on my own money? And the answer is you're not, right? So you have a pool of money that you're funding into this policy. The insurance company will look at that pool and use it as collateral, and they'll loan out up against that balance that you have in your policy. So you're really taking, when you take a loan, the insurance company's money. It's not really your money. So while you are technically kind of using money and double dipping, it's not that you're withdrawing and multiplying those dollars. The insurance company is just loaning you out and holding the balance that you have in your account as collateral, although the entire balance that's in there continues to grow and compound as if you never took that loan out at all. So really important piece to get there. So you can take these loans out anytime you want. You get full control over that. And the other piece people think about is, okay, well, if I hear loan, I hear payment. So what is the payment going to be? What are those terms? Because it's your money in these policies, you don't have to qualify. There's no underwriting process when you want to take a loan. The insurance company will simply lend out against that amount. It's already collateralized. It's already underwritten for the amount that you put into your policy. So you don't have to go through them. So the first thing you're going to do when you set up a policy is you're going to go in and set up an online account with the particular holder, whoever that the carrier is. And that's going to allow you to hook up your checking account or whatever bank account you're going to use. And that's what the loans are going to be deposited in. And it's also what you're going to make, your payments with as well. And so once you do that, you have full control to kind of access your money whenever you want. In terms of payments, because we have that death benefit and we're funding this with our own after-tax dollars, the loan is actually something that you don't have to pay back. In other words, there aren't any specific terms, right? So if you were to take a line of credit or a mortgage out with a bank, there's going to be a whole bunch of terms that you're going to have to follow, right? And it's very rigid. Going back to that element of control, the insurance company allows you to make the terms whatever you want. So there's no set payback period. There's no amount you have to do. They're simply going to charge you simple interest on the money that you loaned out, and you get to pay that back at any frequency, whenever and however you want. So if it's like a bridge loan, you just needed it until you're waiting for the next payment to come in for your business or for a commission check or something, you can go ahead and pay that back as soon as you get paid in full and just include the interest in there. Remember, it's daily, simple accrued interest. So it's going to be much lower than compounding interest. It really can be advantageous there. If you wanted to say, hey, maybe I just want to put this on automatic payments. I took out $25,000 from my policy and I want to pay this back over 2 years at $500 a month or something. You can set up automatic payments through your portal and it'll just send a payment directly back to the insurance company and pay off your loan. If you want to do it in chunks and just do it ad hoc when you get extra money, hey, I had a good month, I want to put $5,000 and pay back a portion of my policy. Great. If you want to do that, once every 10 years, or maybe you just decide you don't want to pay it at all. You don't have to. So again, there's going to be no set terms. And when you don't pay it back, though, you have to remember that interest is going to be continuously accruing year after year. The reason that the insurance company allows you to not pay it back is because they have to, by you buying a policy, pay you a death benefit when you die, which means your spouse, your business partner, your children are going to get a one-time lump sum payout when you pass away. They know they have to pay that out to you anyway. So what they say is, if you take a loan with us and you decide you're not going to pay it back, as we're getting ready to disperse out your death benefit when you die, we'll just remove anything that you owe us in terms of interest in loans. So let's say that you, over the course of your life, took out $200,000 worth of loans and interest, and you never paid any of it back. And the insurance company owes your beneficiaries $1 million death benefit when you die. They're just going to take that $200,000 off, and they're going to pay your beneficiary the $800,000 payout. So it's just going to be the death benefit minus anything that you owe them in terms of interest and payments on that side.